Imagine watching a company's stock jump, like 7% before the market even opens, just because they supposedly beat Wall Street's expectations.
Right, the classic earnings pop.
Yeah, exactly. But then, at the exact same moment, they are quietly burying a $2 billion operating loss.
It is quite the magic trick, honestly.
It really is. So, welcome to today's deep dive. We are looking at a comprehensive equity analysis on General Mills, ticker symbol GIS, and this is following their Q4 fiscal 2026 earnings.
And our mission today is basically to decode what is, frankly, the ultimate financial optical illusion.
Totally. We're going to start with the latest headline news, then we'll break down the core business strategy with some real-world examples, weigh the pros and cons for you as investors, and highlight the critical milestones you need to watch.
Yeah, because the dynamic playing out inside this company right now, it reflects massive shifts in consumer behavior, relentless inflation, and some very creative ways a business can manage how Wall Street perceives its value.
So let's unpack this from the very top. I mean, how does a massive 160-year-old legacy food brand beat estimates by 13 cents a share, but still lose $2 billion in a single quarter? Like, what are we missing here?
Well, the answer really lies in the friction between adjusted metrics and statutory accounting. So let's start with that headline beat.
Okay, lay it on me.
So General Mills reported an adjusted earnings per share of 95 cents. That represents a 27% increase in constant currency.
Which looks incredible on paper.
Right. Wall Street algorithms see that number and boom, the stock pops. Reported net sales even ticked up 1% to $4.61 billion.
But there's always a catch, right?
Oh, definitely. The catch is that this 1% increase was entirely driven by the fact that fiscal 2026 had a 53rd week in its accounting calendar.
I always find this so fascinating. Retail companies often use this 4-4-5 calendar, right?
Yep.
Where quarters are split into 4 weeks and 5 weeks.
Exactly. It keeps the weekends perfectly aligned year over year.
But that only adds up to 364 days. So every 5 or 6 years, you have to magically bolt on a 53rd week just to catch up to the actual solar year.
Yeah, and that extra week gave them literally more days to sell cereal, artificially boosting net sales by a full 7%.
Wow. 7% just from calendar math.
Yeah, and add in some favorable timing of trade expenses, which gave them another 1%, and suddenly the picture looks incredibly rosy.
It's like a runner claiming they just hit a personal best marathon time, but they secretly ran on a track that was, 10% shorter than everyone else's, and they had a tailwind.
That is a perfect analogy.
Because when you strip away that extra week and look at organic sales, which strips out the calendar, quirks, and acquisitions to show what's really happening with consumer demand, organic sales were completely flat for the fourth quarter.
0% growth.
0. And for the full year, they were actually down 2%. Real consumer volume is declining. So is this just standard corporate accounting? Or is management actively trying to mask the fact that people are just buying less cereal?
Well, it's standard accounting, but they definitely lean into the adjusted numbers because consumers have basically hit a wall of elasticity.
Meaning they're tired of price hikes.
Exactly. For years, as supply chain costs rose, General Mills just passed the inflation down to the consumer. A box of cereal went up, frozen pizza went up.
Right.
But eventually, shoppers reject those cumulative price hikes. They start trading down to private label store brands, or they just buy less overall. The volume drops, and that brings us to the most severe consequence hidden in this report.
Which has to be the tax rate. I was staring at the numbers, and the effective tax rate for the year spiked to 102.2%.
Yeah, it looks like a typo, right?
It really does.
Yeah.
At first glance, a company paying more than 100% in taxes seems mathematically impossible.
It does.
But if we connect the dots, that anomaly is like a massive flashing warning light pointing straight to their biggest pandemic-era gamble, the pet food aisle.
Yep, the $2 billion gap operating loss you mentioned at the start, that was entirely driven by a catastrophic $1.75 billion impairment charge in their pet segment.
Let me just do the math out loud on how that breaks the tax rate.
Sure.
So if they take a massive hit on pet food, but a huge chunk of that loss, specifically the goodwill portion, is non-tax deductible, they can't use it to lower their tax bill.
Right, the IRS doesn't care about a goodwill write-down.
Exactly. So their profitable divisions, like cereal and snacks, still generate a normal, hefty tax bill. But because of the pet food loss, their overall corporate net income plummets to near zero.
Exactly.
So when you divide a normal tax bill by a newly obliterated net income, the percentage just explodes to 102.2%.
The mechanics of that are spot on, and I mean, the scale of this impairment reveals a permanent destruction of capital. General Mills bought Blue Buffalo in 2018 for $8 billion.
$8 billion. That's a huge bet.
It was supposed to be their engine for massive secular growth. But of that $1.75 billion charge, $1.5 billion was a hit to goodwill for the North America pet segment, plus another $250 million written off for brands like Nudges and True Chews.
Okay, let's talk about why that value just evaporated. Think about your last trip to the pet store, right? During the pandemic, people adopted dogs and cats like crazy, and we treated them like royalty.
Oh, yeah. Only the best for the pandemic puppy.
Right. People were buying the absolute top-tier premium wild-caught salmon kibble. Now, with inflation biting into everyone's wallet, it's like we're realizing, hey, the dog can just eat regular dog food. Are we seeing the permanent end of this pet humanization premium?
Well, the financials strongly suggest the peak of that premium era is behind us. Every year, auditors look at the projected future cash flows of a brand to justify the goodwill sitting on the balance sheet.
Okay.
But recently, interest rates have gone up. That means the discount rate, or the weighted average cost of capital applied to those future cash flows, goes up too.
So, to translate that at a finance speak, future money is literally worth less today because borrowing costs more right now.
Right.
So the hurdle to prove a brand's value is just significantly higher.
Exactly. And combine that higher discount rate with consumers trading away from premium pet foods, and the math just forces the company to write down the value on their balance sheet.
That's brutal.
It is. Plus, management is facing insane margin pressures from digital retail algorithms.
What do you mean by that?
Well, people aren't just browsing the aisles at a specialty pet store anymore. They are setting up automatic subscriptions online where pricing algorithms aggressively race to the bottom, squeezing the manufacturer's margins.
Right, the whole set it and forget it delivery model.
Yeah.
And I saw they mentioned pet sales actually reported a 4% gain this quarter, but that's another mirage, isn't it?
Completely. It's masked by the 53rd week and the fact that they recently spent $1.4 billion acquiring another company, Whitebridge Pet Brands.
Okay, so if you isolate organic pet sales.
They actually fell 3% in Q4.
Wow. So management is looking at this declining volume across their portfolio, and they are initiating a massive structural overhaul. Under their accelerate strategy, by the time their current deals close, General Mills will have turned over nearly 1/3 of its entire 2018 portfolio.
Yeah, 1/3 is a massive reshaping of the house.
It's crazy. Let's look at what they are actively carving out. They're selling their Brazil division, which includes brands like Yoki and Kitano, to a company called Three Corações for $153 million. But this triggered a $1 billion pre-tax loss.
Yeah, that billion-dollar loss is largely due to historical accumulated foreign currency translation losses.
Which sounds incredibly complicated.
Think of it like keeping money in a foreign bank account for a decade while the exchange rate slowly bleeds out. You take paper losses every year as the Brazilian real fluctuates against the dollar.
Oh, I see.
But accounting rules dictate that when you finally sell the asset, you have to recognize all those paper losses on your income statement at once.
Got it. So it's a painful Band-Aid to rip off, but I guess it removes a highly volatile, inflation-prone international market from their portfolio.
Exactly. Clean up the balance sheet.
Then there's the North American yogurt business. They are selling off brands like Yoplait and Liberté to French dairy giants for $2.1 billion. Now, that transaction actually generates a $1 billion pre-tax gain, which looks fantastic on paper.
It looks fantastic, sure, until you consider the revenue they're giving up.
Yes, that is exactly my sticking point here.
Yeah.
I mean, wait, they are selling off their North American yogurt brands, which brought in $1.5 billion in sales last year just to improve their overall percentage margin.
Yep.
Aren't they just shrinking the company to look better on a spreadsheet?
You've hit on the very real issue of stranded costs. The rationale for the sale is that yogurt is a highly commoditized, low-margin business in North America.
True. There are a million yogurt brands now.
Right. Supermarket shelves are flooded, private labels are dominant, and General Mills has virtually zero pricing power there. They want to redirect that capital into higher-margin, global platforms where they actually have an edge, like Haagen-Dazs ice cream globally, or Old El Paso.
I get the strategy, but the stranded costs don't just disappear. Let's use an analogy for this. If you have a massive house with 4 roommates splitting the rent and 2 of them move out,
Okay, I follow you.
the house might look cleaner and your margin per room might look better on a spreadsheet, but the remaining roommates are suddenly crushed by the overhead rent.
That's a great way to put it.
Right. When General Mills sells off $1.5 billion in yogurt revenue, They don't instantly eliminate all the corporate overhead, the IT systems, or the administrative costs that supported it.
No, they don't. Those remaining costs eat into the margins of the surviving business. They are leaving an enormous revenue hole that they now have to fill.
And filling it is going to be incredibly difficult because they can't pull their favorite lever anymore. They can't just raise prices.
The consumer's totally tapped out. Price-led actions have officially failed. Brands like Totino's Pizza Rolls and Wilderness Pie Fillings were major drags on Q4 volume.
I mean, think about your last trip to the grocery store. When you saw the price tag on a bag of frozen pizza rolls, you probably just kept walking.
Exactly. You, the listener, you are the consumer wall General Mills hit this quarter.
So if they can't raise prices, what's the pivot?
They are abandoning price hikes and betting everything on a new strategy they are calling brand remarkability.
Brand remarkability. I gotta say, that sounds like a buzzword generated by a marketing algorithm. What does that actually look like in practice?
It basically means investing heavily in product innovation and pop culture relevance so consumers actively seek out the product rather than just buying it out of habit.
Okay, give me an example.
Well, they are leaning into the high protein trend. They launched Cheerios Protein and it hit $100 million in sales. They're also doing massive pop culture marketing, like a collaboration with the rapper Glorilla for Reese's Puffs.
Oh, yeah?
Yeah, and they ran 4th of July pet promotions on Instacart.
I also read they gave away 1 million free Betty Crocker cakes through rebates to celebrate the brand's 160th anniversary. But, I mean, giving away 1 million cakes completely destroys your gross margin on that product.
It does. It's incredibly expensive.
So what does this all mean for the grocery aisle? It sounds like they're trying to pay for flashy rap collaborations and free cakes by squeezing blood from a stone in their supply chain. How are they paying for this?
Well, to fund this remarkability push, management announced a staggering $3 billion cost-saving mandate to be achieved by fiscal year 2030.
$3 billion with a B.
Yep. They plan to extract $2 billion of that from an expansion of their holistic margin management program.
Okay, let's unpack holistic margin management. Usually when a mature food company says they are optimizing packaging and standardizing supply chain efficiencies, what they actually mean is thinner cardboard, cheaper ingredients, or putting 10% less cereal in the exact same size box, right? Shrinkflation.
Right. And then the remaining $1 billion is supposed to come from a global transformation initiative.
Which sounds even more vague.
We are talking about utilizing AI for omnichannel execution, radically simplifying the business model, and potentially closing and consolidating manufacturing plants.
So real job cuts and plant closures.
Exactly. And there is severe tension in this strategy. The board has mandated that $750 million of those savings must be realized in fiscal year 2027 alone.
Wait, but input costs like raw materials, labor, transportation, those were still inflating by an estimated 4 to 5%, right?
They are.
So that $750 million in savings might just get entirely eaten up by the rising cost of flour and freight. Can you really cut $3 billion out of the operations without ruining the actual quality of the food?
That is the big unknown. They might be cutting billions out of the operations just to survive, not even to generate extra cash to fund these new marketing campaigns.
This tension perfectly sets up the battlefield we are seeing among investors right now.
Yeah.
Because the divide in how the market views this company is stark, especially when you look at their fiscal year 2027 guidance.
Yeah, they are projecting organic sales to be somewhere between negative 1.5% and positive 0.5%.
So flat or shrinking.
And the profit projection is worse. They are guiding for adjusted earnings per share of $3 to $3.20. That is a 15% drop from the $3.55 they made in fiscal 2026.
Yikes.
They are signaling a third consecutive year of an earnings recession.
A third year of shrinking profits. If you spend time on platforms like Reddit, in the value investing communities, retail investors are furious. They're calling General Mills a wealth destroyer and a classic value trap.
Which makes sense from their perspective.
Right, because on paper, the stock looks cheap. It's trading at a forward price-to-earnings ratio of around 13.8. For a legendary blue-chip food company, a 13.8 PE usually looks like a screaming bargain.
But it's only a bargain if the earnings part of the equation is stable. If the earnings keep deteriorating by 15% a year, that 13.8 multiple is an illusion.
The stock is actually getting more expensive as the fundamental business shrinks.
Exactly. Institutional analysts largely agree with this caution too. The overwhelming consensus on Wall Street right now is a hold. Firms like Jefferies have set price targets around $36, indicating they just don't see any near-term catalyst for growth.
And the institutional money also sees a surprisingly tight balance sheet. Their current ratio sits at just 0.68.
Yeah, that's tight.
To put that in perspective for you, a 0.68 current ratio means for every dollar of short-term bills due in the next 12 months, the company only has 68 cents of liquid assets on hand to pay them.
Right, they manage their working capital aggressively by stretching out payables to suppliers.
But it's essentially the corporate equivalent of living paycheck to paycheck. It leaves very little room for error.
The counter-argument, though, and the reason many investors refuse to sell is the dividend.
Ah, right, the dividend.
The stock is paying a 5.5% dividend yield. They have an unbroken 127-year streak of paying dividends, stretching all the way back to the 1800s.
Which is insane longevity.
Truly, the CFO has explicitly stressed that they are targeting a 95% free cash flow conversion rate for FY27, specifically to protect that payout. For income-focused investors, a 5.5% yield from a company that sells Cheerios feels like a very safe bunker in a volatile market.
I mean, a 5.5% dividend yield looks amazing on the surface, but we have to look at the sacrifices being made to protect it. They quietly slashed their share buybacks, cutting them from $1.2 billion down to $500 million.
Don't you cut?
If they're slashing share buybacks, turning over a third of their portfolio, and projecting a 15% drop in earnings, isn't that dividend just a shiny coat of paint on a sinking ship? Are retail investors right to be angry?
It frames the ultimate investor dilemma with General Mills today. On one side, you have income investors hiding behind the safety of a 127-year track record, accepting zero growth in exchange for reliable cash flow.
And on the other side,
You have growth and value investors fleeing a company that is losing consumer volume, cutting buybacks, and shrinking its footprint just to tread water.
as we wrap up this deep dive, there are a few critical milestones you need to watch to see which side of that battlefield is actually going to win out. First, track that $750 million cost-saving target for fiscal 2027.
Right. Can they actually execute those massive operational cuts without sacrificing product quality or causing supply chain disruption?
Exactly. Second, watch the organic consumer volume in the upcoming quarterly reports. Will this expensive brand remarkability marketing actually reverse the decline? Or is consumer fatigue with current price levels a permanent structural change in the food industry?
Yeah, that's going to be the real test of their strategy.
Next time you are walking down the cereal aisle or deciding which bag of dog food to throw in your cart, you'll understand the multi-billion-dollar, high-stakes tightrope act happening behind every single price tag on that shelf.
Every choice you make in that aisle ripples all the way up to a boardroom trying to figure out how to squeeze $3 billion out of a supply chain.
The grocery store really is the front line of macroeconomics.
It really is.
Which leaves me with one final kind of provocative thought to mull over. We've spent this entire time talking about massive financial maneuvers. If a 160-year-old legacy food company has to constantly buy and sell off one-third of its entire portfolio, engineer 53-week accounting boosts, and slash billions in operational costs just to maintain its profit margins on paper, at what point does it stop being a food company and start functioning more like a private equity firm that just happens to sell cereal?
That's a fascinating way to look at it.
The financial optical illusion we talked about at the start, maybe the biggest illusion of all, isn't the earnings beat. Maybe it's the idea that they are still fundamentally in the business of making food. Something to think about. Thanks for joining us on this deep dive. See you next time.